Why do portfolios fail? That's a great question. And after 40 years in the cockpit, I learned a hard truth about safety. Airplanes don't just simply fall out of the sky for no reason at all. Matter of fact, in military aviation, we studied something called the accident chain of events. And what we found was that catastrophic failures almost never come from one massive event. They come from a series of small yet manageable problems that begin to line up over time. And what we find is that we have a small oversight here, a little bit of pressure there. And individually, none of these would have caused a severe crash in your portfolio. But when you connect them up, the outcome becomes simply unavoidable. Retirement portfolios fail the exact same way. It's almost never one bad day in the market that wipes somebody out. It tends to be a series of small decisions made at exactly the wrong time. And right now, we're currently navigating a very uncertain environment driven by geopolitical tensions and energy shocks around the world. And this is exactly when the accident chain begins to form. Today, I'm going to show you how to break those links using the same disciplined approach that allowed me to step away from my profession after about 4 decades in aviation on my own terms. And let me start with this first link in the chain, and that's called the market decline. What you're seeing right now in the headlines as I speak, it's not unusual. If you're invested in broad market funds such as VTI, volatility is the cost of admission. A bear market, defined as a decline of approximately 20% or more, is a normal part of this cycle. And historically, we see this every 5 to 6 years, such a decline. And by itself, this is not a disaster. Your portfolio is designed, in fact, to handle it, hopefully. But this is where the chain begins to break down. This is the moment that forces bad decisions. If you do not have a plan for this phase, the link starts connecting. The second link is the environment. When markets fall, the world feels more dangerous. The headlines get louder. The predictions, they get darker. Every expert suddenly has a reason why this time's going to be different. And what does it do? It creates pressure. You start checking your portfolio count more often. Your time horizon shrinks. Instead of thinking in terms of years, you start thinking in terms of days, maybe even hours. And when that happens, you stop acting like an investor and you start acting like someone in a crisis. The third link is where things get really serious. That's called the cash flow crunch. If you are retired and the market is down, your bills, they don't stop. Property taxes still have to be paid and they still show up in the mailbox. Monthly expenses continue. If you do not have a buffer, you're forced into a really bad decision. You have to sell assets while they're down just to generate income. This is forced liquidation. And this is where the real damage happens. You're reducing your share count at the exact moment those shares are discounted. That creates a hole in your portfolio that is extremely difficult to recover from. Because when the market rebounds, you no longer own as much of it. This is the link that turns a temporary decline into a permanent loss, sometimes referred to as sequence of return risk. All right, now let's talk about the fourth link, the final one. And that's the panic decision. Eventually, the pressure begins to build to a point where you say, I need to move cash before things get worse. That feels safe in the moment, but it is the most damaging move you could possibly make. Because when you sell in a downturn, you lock in the loss. And history shows that markets recover faster than your emotions do. If you step out during that fear, you miss the strongest part of the rebound. You walk away from your plan at the exact moment It was about to work for you. Now, here's the good news. You do not have to fix everything. You only have to break one link in the chain to stop the insanity. In my own plan, I do what I call the insurance mode. And this is not a product. It's not an annuity. As a matter of fact, it is a cash reserve. Sometimes you'll hear me refer to it as bucket one. I keep 1 or 2 years of living expenses in liquid cash. I do not look at that money as an investment. As a matter of fact, you can't. I look at it as protection. When volatility hits, I do not pull from my investments. I pull from this reserve, this bucket one reserve that buys me time. And time is the most valuable asset you have in a downturn. Why 1 or 2 years? Well, because the data supports that. Looking back over the last 50 years in the model that I looked at, the market has always recovered from major declines, but it takes time. And on average, it takes about 1 to 2 years, leaning more towards the 2 years to recover from a 20% drop in the stock market. If your cash reserves covers that window, you break the chain. You never connect market decline to forced liquidation. You simply wait for conditions to improve. Now, let me show you how I stay disciplined. I follow a very simple checklist. Here we go. Every January the 1st, I just did this. I review my allocations. If my portfolio has drifted more than 5%, I rebalance. I will not do that during the course of the year because it's just too static. It's too dynamic. That keeps things aligned with my plan. Then there is a second rule that I follow. And if the market drops 20% or more, I rebalance again. I don't wait for that calendar Jan 1 to rebalance. I take action then. That means I'm systematically buying assets when they're down or on sale, as a matter of fact. It removes emotions from the process. It keeps me operating based on a plan, not a feeling, and even better, I can sleep at night. That's what I like most about this plan. And before we wrap up, just a quick note. Remember, I'm not a financial advisor, nor do I hopefully act like one. What I am is a retired captain sharing the flight plan that has worked for me for over 40 years. You should always consult with a professional before you make really difficult decisions in your portfolio. Markets declines, they're going to happen. That's not the risk. The real risk is how you respond to those declines. Once you understand the links in the chain, you can break them. You have the tools, you have the structure, you are in command, and if you're using cash buffer or a rebalancing strategy to navigate the environment, share your experience in the comments below. I'd appreciate that. Some of my best episodes, in fact, have come directly from those conversations that I have. And I read and respond every Sunday unless I'm far, far away. I release a new episode of the Captain Guy Show every Saturday at 10 a.m. Central Standard Time. So be looking for this particular episode. That's when it'll break. Take a look through the channel for more content on matters regarding finance and health and travel and navigating retirement with clarity. And remember, health is wealth. Wealth is freedom. Let's get busy living. Thanks for listening.